Now, flipping over to the carbon side, we were obviously seeing carbon prices come off like a rock. We talked for the last several months about this, that the price of hot roll, as we're showing here in this chart, actually sold off faster than it even ran up, which is pretty crazy to say. We went from about 1950 per ton all the way down below $1,000 per ton. Well, we're not there anymore. So what happened? Well, I think I mentioned this on the last call, but the United States imports about 3% of Russian and Ukrainian material. So it's a fairly low percentage. So why would we see prices spike? Well, Europe is in a very different scenario. Europe has an import penetration of material from that region that amounts to about a third of their overall volumes. So as soon, again, given this close proximity to that region, Europe just has much stronger linkages and exposures to the commodities of those regions than we do. So almost instantaneously, when the invasion happened, things like pig iron, things like scrap, and obviously the availability of steel became much more difficult and much more expensive for the Europeans. And you can see the price in Europe spiked a couple of weeks before the United States, and it spiked in a big way by about $500 per short ton. Now, as we think about the knock-on effects to the United States, well, if the price of Europe is going up by $500 and the US is a net importer of steel, well, all of a sudden, that next incremental ton that we may have to buy to fill our demand situation, it's just gone up by 40 or 50%. So almost instantaneously, you saw a lot of the domestic mills hike prices by several $100s, and many of those for now are sticking. So I would say that really is the crux of what's occurred, is just the next best set of pricing in the global market has gone up by 50%. So it'd beholden the US mills to say, we got to take prices higher too. And you can see US prices quickly went from about $950 all the way up to about $1,500 a ton. It's interesting because you look down at China, and China continues to not have these same issues. Obviously, we can't buy Chinese material direct because it's got tariffs and duties on it of several 100%. But it's amazing, all of these situations that are happening within Europe and within North America, they just aren't happening within China right now. And yeah, it's an interesting dynamic for sure. And then maybe secondarily, the other factor that has had an impact to a lesser degree, I would argue, would be the price of scrap, which is shown, busheling scrap is shown in the blue line, and then the white line is going to be iron ore. Both of those markets have rallied fairly substantially. Iron ore even rallied prior to the Russia-Ukraine situation. But all of that being said, I think it's important to note that even with scrap currently sitting up around $800 a ton, if you come back to that normal equation of steel mills being okay with kind of a $250 to $300 spread, $800 scrap kind of puts your hot roll price at $1,100. We're obviously well in excess of that. And I think that's just because we've got European prices that are also well in excess of that. So your next best good place to find steel just got 40 or 50% more expensive. A little bit of good news to leave you with on the carbon side of things before we hop over to Q&A. This is the historical futures curves. The blue line being 6 months ago, you can see the trajectory was massively down, which we did actually see transpire. The green line is as of a month ago, so basically the last time we all spoke. And it was actually forecasting a little bit of what we've seen in the last 3-4 weeks. If anything, it slightly undershot how far we're ultimately, or how high we're ultimately going with regards to price. But the good news is, as we look here at the orange line, there is a little bit of downward slope in the current futures curve, which, as we think about what the futures market represents, it is a best guess look into where traders think the futures price or the future price of steel is going to be. And as we sit here today, traders are basically saying, yeah, we'll see elevated prices relative to where we were 2-3 months ago, but there could be a little bit of a cooling off effect as we roll through time. And I think part of that is explained by the fact that, this spike in Europe may perhaps be temporary. If we rewound to 3-4 years ago and asked the question, is the world short steel? everyone and their brother would say not at all. China's overproducing, and that's why we put tariffs on China in the first place. Not that much has changed here today, but I do think it takes a period of time for Europe to rework its supply chains. And what I mean by that is, about a week ago, Europe, for the first time ever, actually bought carbon slabs from China. So they're basically using that as a raw substrate to re-roll and make their own steel from Chinese substrate. So I think there are some things taking place that are just kind of reworkings of the supply chains that will eventually, cause things to hit a little bit of a headwind on the rally, and then maybe things can subside a little bit. So that's at least what the futures market is suggesting at this point in time. And with that, we will take some Q&A if we have any.
Nick, what's the latest on capacity utilization? We haven't touched on that in a while. How's that looking these days?
Yeah, it has been a bit. I mean, as we sit here right now, the official capacity utilization percentage is right around 80%. It's actually just a touch below that. So I would say that's fairly standard. So I would say with regards to operations, they aren't running too hot, but I wouldn't say there's panic producing either. So it's a fairly standard range, around 80%.